Good day. Welcome to another session of Fog Accountancy Tutorials. We are going to continue our study on IAS2 inventories. And like I promised you, we are going to solve questions to further enhance our understanding. Now, in the part one of this lesson, I explained the basic concepts that we need to understand as far as IAS2 is concerned, with the fundamental principle being well elaborated. Now, in this video, I'm going to solve questions. Now, I'm going to solve first two questions on the principle of lower of cost and net realizable value. We're going to look at how it's going to be applied practically. And then from there, I'll also solve a question on the components of cost. And then maybe finally, I'll talk about the FIFO and then the weighted average method of valuation and look at a question relating to that as well. So without wasting my time, I would want to go straight to the question and then solve with you. Very simple questions. Now, the first question. An equipment was constructed for a customer for an agreed price of 20,000 Ghana cedis. This has recently been completed at a cost of 18,600 Ghana cedis. It has now been discovered that in order to meet certain regulations, selling the equipment will attract an extra cost of 5,000 Ghana cedis. The customer has accepted partial responsibility and agreed to meet half of the extra cost required. Value the inventory for accounting purposes in accordance with IAS2 inventories. All right, so this is a very simple, short, and straightforward question, testing our knowledge on the fundamental principle of IAS2. Now, we are told from the question that we are constructing an equipment to be sold to a customer, and that makes it fall under the category of inventories, even though it's an equipment. Remember that inventories are assets that are being constructed for resale or for sale. Once it's being constructed with the motive of selling, then it's inventory. Now, we are saying that the agreed price to sell the inventory is 20,000. So let us pick the key points and try and solve this question. So the cost, let's say the selling price, the agreed selling price for the item is 20,000. Yes, 20,000. Okay, and then we are told that this has recently been completed at a cost of 18,600. So the cost of constructing the asset is 18,600. Now, let's analyze something. Don't be confused. You see that if we sell the inventory, we are going to get 20,000 Ghana cedis. That is the realizable value. The realizable value is 20,000 and the cost is 18,600. We are supposed to pick the lower of cost and net realizable value. This is a realizable value. It is not netted yet. So let's continue to read. Now, we are told that before we can sell this equipment, we need to cover an extra cost of 5,000 because of regulations in the industry. And therefore, we are going to sell for 20,000. But the cost to sell, remember that net realizable value is the selling price minus the cost to sell. How much you are selling it minus how much you incur as cost in selling. The cost of the item is how much you have actually incurred in producing it. However, the selling price or the sales proceed is going to be 20,000 for the item of inventory. And then we are told that we are going to incur an extra cost of 5,000. So if we are netting off this 5,000 from 20,000, that should have been left with a net realizable value of 15,000 to compare with the cost. However, we are told from the question that the customer has accepted partial responsibility and agreed to meet half of the extra cost. So that means that to the organization, this 5,000 is not going to be a cost borne by the organization. This 5,000 will be split between the customer and the organization. Therefore, half of 5,000 is going to be 2,005. So if you want to establish the variables for comparison, so let us take note of all this information and then re-establish that the cost remains 18,600, but the net realizable value is going to be 20,000 Ghana cedis minus the cost to sell. And we are told that this 5,000, which is the cost to sell, only half is being borne by the organization. So that's going to be 5,000 divided by 2. And that's going to give us 2,500. So therefore, it's going to be 20,000 minus 2,500. That's going to give us 17,500. So now, these are the two main variables for comparison. The cost is 18,600. The net realizable value, which is the selling price minus cost to sell, is 17. Now, according to the fundamental principle of IS2, so you see, I told you that with standards, when you are solving standards, sometimes it's not just about the calculations. You also need to write some English to add up, to explain what you are saying. Sometimes you need to quote the law of the standard that you are applying. So according to the fundamental principle of IAS 2, you say that inventory should be valued at the lower of cost and net realizable value. Looking at the cost and the net realizable value, the least of them is 17.5. This is lower than 18,600. So you conclude in writing that therefore the inventory will be valued in a financial statement at the value of 17,500. And that is how we solve the first question. Very, very easy and understandable. I'm sure this question is very clear. Now, let us look at another question which comes in a different form, also testing the same fundamental principle. The next question. Shapiro Enterprise has 3 products in its inventory as follows. So we have product A, the cost is 10,000, net realizable value is 12,000. Product B has a cost of 11,000, net realizable value of 15,000. Product C has cost of 12,000, net realizable value of 9,000, giving us a total of 33,000 for cost, 36,000 for net realizable value. The requirement is, at what value should the inventory be stated in the statement of financial position in accordance with IAS 2? So this is another question that is testing us on the fundamental principle of IAS2. We are given 3 different categories of inventory, and for each of them, we are given the cost and the net realizable value. So straight away, this is something that is very easy, much easier than what we did first, because the net realizable value has already been given. Now, if you are not careful, you will pick the totals, okay, and say that the total cost is 33,000. Total net realizable value is 36,000, and therefore the lower of the two is 33,000, and therefore the inventory should be valued at 33,000. You'll be making a mistake because the inventories are not of the same category. So what you need to do is that you pick each inventory one by one based on the fundamental principle, and then you sum it up and know which of the two to pick. So therefore, the solution to the question now, inventory A, okay, cost, okay, so we have it already in the question. Now, the cost for inventory A is 10,000 and the net realizable value is 12,000. So based on the two, which one should we pick? We are picking the lower, which is 10,000. All right. Then inventory B has a cost of 11,000, net realizable value of 15,000. The lower of the two is 11,000. So for B, we are going to value it as 11,000. And then for inventory C, cost is rather higher, 12,000. Net realizable value is 9,000. So for inventory C, it's 9,000. So now, after we have selected the least among each of them for the 3 different inventories, then we can add them up to find the total valuation. So therefore, we have 30,000. And so you write that the inventory of Shapiro Enterprise will be valued at 30,000 Ghana cedis in their financial statement. Now, if you had picked the totals from the question straight away, you would have gotten it wrong because you would have thought that you would have selected and thought that 33,000 is the lower among the totals. However, in doing the right selection, you realize that you are getting 30,000 instead of the 33,000 you have in the question. So whenever you are faced with a situation like this, you always have to select them individually. And after you have gotten the lower of each of them, you sum up the total value of the lower, and then you have a total value to be included in your financial statement for the inventory. So this is the solution to the question. But remember to write some English to conclude. It's always important that your standard questions, you answer them with English that describes the rule that you have applied. Okay. Okay, so now the next question that we are going to pick is not testing us on the fundamental principle, it's testing us on the components of cost. Okay, so let us look at the question and then solve it. This is testing us on the components of cost for inventory. So illustration 3. Calculate the cost of inventory in accordance with IAS2 from the following data relating to Adachi Limited for the year ended 31st December 2021. So we have direct costs of an opener per unit is 1 cedi, 1 Ghana cedi. And then direct cost of an opener or a can opener per unit for direct labor cost, sorry. Then direct labor cost of a can opener per unit is also 1 cedi. Then direct expenses of a can opener per unit is 1 cedi. Then we have production overheads per year, 600,000 Ghana cedis. Administrative overhead per year is 200,000 Ghana cedis. Selling overheads per year is 300,000 Ghana cedis. Then interest payments per year is 100,000 Ghana cedis. So you can see that they have mixed them up. Some should be included, some should be excluded. Remember what we learned from the part 1. Okay, but we'll select the right ones. Now we continue reading. Additional information. There were 250,000 units of finished goods at the end of the year. So that's the total production. You may assume that there were no finished goods at start of the year and there were no work in progress. The normal level of production is 750,000 can openers. But in the year ended 31st December 2021, only 450,000 were produced because of labor disputes required. Determine the value of finished goods. Okay, so this is quite a complex question, not too complex, but it's testing you on the components of cost. Now, this is even very easy. All you need to do is to be able to pick the right components, find their right values, add them up, and then you have your total cost, and that is the total value you are being required to estimate. We are going to solve this for Adachi Limited. Now, you need some level of knowledge from management and cost and management accounting, specifically on cost estimation, to be able to do this. You need to understand how overhead are absorbed to be able to do this. If you do not understand cost estimation, you will be found wanting in solving, because this is purely cost accounting knowledge that you need to apply. And in fact, most of the questions of inventory needs your knowledge from cost accounting. So let us do this. So cost estimation for inventory. Now, if you remember the components of cost of inventory, we said that the purchase price or the direct material cost in this case represents the purchase price of inventory. That is the direct material cost. And then there is conversion cost. The conversion cost represents direct labor costs, direct expenses, and any production overheads. That is all. And we said any other cost that is attributable. Now, in this question, we have direct material. We are given that the direct material cost, which represents the purchase of the materials, is absorbed at 1 cedi per each unit produced. And if you go down there, you need to multiply each of that, because you see, whatever you are given here, they are saying per unit, direct material cost per unit. That is that is the direct cost of can opener per unit. So we have direct labor cost also per unit. Direct expenses is also given as what? Per unit. So for those three, you need the total units produced in order to multiply and then get the values. So you bring your currency sign and then you say that the direct cost or direct material cost will be 1 CD times the total production. Now the total production is 250,000 units from the question. So that gives us 250,000. And then you need your direct labor cost, which is also 1 CD per unit. And the total unit is the same 250,000. So we have 250,000 for direct labor cost as well. And then direct expenses, which is also part of conversion cost, was also given as 1 CD per unit. And the total unit is 250,000. So we have the same figures for direct material, direct labor cost, and the direct expenses. So that gives us 750,000. Then we continue to pick the production overheads. Now, note from the question that administrative overhead will not apply. It is an exclusion, so don't bring it here. Selling overheads is an exclusion. If you remember carefully from what we did in part 1, interest payment is an exclusion. That will also not appear. So the only relevant item left here is the production overheads. And to bring in the production or the factory overheads, you cannot pick the 600,000 and bring it here. That is where the mistake will come from. A reason why I say you need knowledge of cost estimation in management accounting to understand that overheads are absorbed based on overhead absorption rates. And therefore, we need the knowledge of overhead absorption rate. We need to calculate an absorption rate for this overhead before we absorb it into the cost. It is not straightforward. So if you pick 600,000 and you bring it here, you have a problem. Now, take note that we have 250,000 units of finished goods were produced, but the normal level of production is 750,000. That 750,000 will term as the budgeted production units. And we are going to use that to calculate the overhead absorption rate. Very, very important. So therefore, the overhead absorption rate is going to be the 600,000, which is the total overhead. Remember that it's total overhead over units produced. So 600,000 Ghana cedis, that is the total overhead, all over the budgeted units of 70,000 on the normal unit. So this is the predetermined absorption rate. Okay, so that is going to give us a rate of 0.8. So it's going to give us 80 pesos per unit. So because normal production levels are 750,000 units and the total overhead of 600,000 is incurred, then the overhead absorption rate is 80 pesos per unit. And this is very important for our understanding. So now that we have our overhead absorption unit to be 0.8, overhead absorption rate, sorry, to be 0.8, we can now come and calculate and find our production overhead cost to be added. So production overhead will now be 0.8, which is 80 pesos, times the total production units, which is 250,000. Now, please don't be confused. 250,000 is the actual production unit. 750,000 is the budgeted. Okay, the budgeted units. So therefore, we use the budgeted units to calculate the overhead absorption rate, and then we apply on the actual units produced. And so 80 pesos of 250,000 is going to give us 200,000 Ghana cedis. And remember that factory or production overhead will be part of the component of cost of inventory. Now, this is the most important, and that is all. Maybe you are confused with the other information that was given. We are told that, but in the year ending 31st December 2021, only 450,000 were produced because of labor disputes. Now, don't get confused. The actual unit produced is not 450,000 units. Okay, the finished goods, we are told that there were 250,000 units of finished goods. The 450,000 units is referred to as produced, but we are not specific they are finished goods. Okay, the finished goods is specifically 250,000. As to the 450,000, they are just drawing your attention to the fact that the budgeted was reduced due to abnormal waste. And remember that abnormal waste will be expensed. It's not part of the component of inventory. So the question would have been easier even without that. Or in other words, let me tell you that that 450,000 is irrelevant. Don't use it. Always focus on the finished goods. The 450,000, I'll tell you, is there to confuse you. Don't touch it. Just focus on the finished goods. Find your overhead absorption rate and then multiply by that, and then you have your total production overheads. So now that you have this, you can add them up. And therefore, your total value of inventory will be 950,000. So then you can, as usual, write your English that therefore the value of inventory to be included in Adachi Limited's financial statement is 950,000. This is the cost of inventory. Now, these questions can be complex. So you need to take your time and learn what I taught you in the part one. Learn and get them at your fingertips, the components of inventory. The only tricky thing here is the overheads that we didn't just pick the 600,000, but we have to find an absorption rate before bringing. And you really need to understand these things from your management accounting before you come to apply in IAS 2. All right. And then finally, I want us to look at a question that relates to the valuation of inventory using FIFO and weighted average. Now, IAS 2 permits only those two methods, FIFO and weighted average. LIFO has been scrapped way back as at 2003. That was when they stopped using LIFO. So I'm going to give you a question that you require the FIFO and LIFO to do the valuation. The FIFO, sorry, and the weighted average to do the valuation. However, I'm not going to solve this question. I'll just read the question with you, and I'll task you as an assignment to try and solve that question. If you're having difficulties, I refer you to my video on FIFO and weighted average so that you go and then learn how to do that and come and apply it on this question. And I'm sure you'll be fine after watching that video. So let us look at the question. Purchases of a certain product during the month of January 2014 were, so we have January 1st, 100 kg at 10 cedis. January 12th, 100 kg was purchased at 9 cedi, 80 pesos. 15th, 50 kg at 9 cedi, 60 pesos. And then 20th, 100 kg of the material at 9 cedi, 40 pesos. Then we continue. Units sold during the period were January 10th, 80 kg, January 14th, 100 kg, and then January 30th, 90 kg. Required. Assuming no opening inventories, determine the cost of goods sold for January 2014 under the two methods of FIFO and weighted average. All right, so this question you see on your screen is an assignment. So go and then try and solve it, and then let me have your answers in the comment section. I'm sure you would be able to do this. So we have come to a very important climaxing point of IAS 2, which I believe you have understood what we have done so far. There could be a part 3 of this video where I'll solve complex questions. But for now, I'll move on to other standards and then try and get them to be understandable as I have made this. Remember to subscribe to the channel if it's your first time. Share this video and let others also have a benefit. And until we meet again for another video, it's bye for now. Thank you.